Greetings, traders, and welcome back to another In-Depth with Chris episode. In today's discussion, we will be talking about the Donchian Channel. This is a technical analysis-based indicator that can help us find opportunities in the market if we understand its read. So as such, we're going to talk about exactly what the Donchian channels are, as well as cover some trading strategies that can be applied once we understand exactly what we're looking at. This is the type of information that I hope will help you pass your Gauntlet Mini if you plan on taking the challenge. And before we go any further, if you could do me a favor, folks, please click that like and subscribe button down below so I can keep coming out with content for all of you. Now, without further ado, let's dive on into those Donchian channels. Bzz. In the technical analysis world, you will rarely find an indicator that is capable of presenting historical volatility, signaling potential breakouts, reversals, pullbacks, as well as identifying overbought and oversold signals all at once. The Donchian channels are one of these indicators that arguably is able to do all of these things when we actually understand it. So let's start off with covering what the Donchian channel looks like and what it is by a definition. Well, from a definition standpoint, the Donchian channels are an indicator that comprises of three lines that help show price volatility, trend breakouts, reversals, and all those other things that we mentioned. This is what it looks like on a chart. We have a line on the top side, a line on the bottom side, and a line in the middle. Now, my black lines are a lot darker than it, so I'm going to go ahead and get rid of them, but you can see that throughout this movement of price along this chart, there has been some degree of a channel that widens and gets skinnier at various points, as well as represents areas of potential support, resistance, and breakout locations along the way. This is what a Donchian channel might look like depending on which trading platform you're using. It is always something that is going to consist of three separate bands that are generated by moving average calculations. The central part of the indicator is the mid-range band, which is this orangish line here. Then we have an upper and lower band like we mentioned. The middle band is just simply an average of these other two bands. And we can calculate this value over a specific number of periods to decide exactly what the right settings for the circumstances that we're currently measuring are, or just how much information we want the channels to take into consideration. This indicator dates back to the 1950s. The name for it came from the man who invented it, Richard Donchian, also known as the father of trend following. As a futures trader, he needed a straightforward tool to help measure volatility, which at the time was a very challenging task to complete. Traders apply the Donchian channels on a variety of assets and time periods. While it was first intended to only be used on daily values, today it is quite easily applied and considered effective on charts as small as minute time frames. The Donchian channel is an indicator that is quite similar to the Bollinger Bands in the way it looks and operates, but it isn't exactly the same, and there are times where the Donchian channel might provide an opportunity that the Bollinger Bands does not. Let's talk about how to interpret what the Donchian channels are telling us. At the basic level, when volatility is high, the bands of the indicator are positioned wider. On the other hand, when the market is calm and prices are arguably more stable, the bands become more narrower. Now, if price reaches the upper band, then we are considering an overbought scenario. If it touches the lower band, we are considering an oversold scenario. However, we should bear in mind that such scenarios are standard, and every time the market reaches an upper or lower band does not necessarily mean that we want to just simply execute with some type of reversal to be expected. And the reason behind that is just like Bollinger Bands. When a trend is strong and has reached the upper bands, there could be an indication here that is actually quite the opposite of a reversal. As price rises and gains momentum, the Donchian channels are going to continue to outline the high points of price, which means it will rise with price, and it is possible that you see a scenario like this where the price is actually lined up with that upper band. And when we see the market breaking areas that were previously resistance drawn by the Donchian channel, that can be an indication that if price is sitting at the top of the band and not showing any real strong signs of resistance, then we would want to interpret being at the top of the band as a sign of incredible buying strength and not consider it as a complete overbought scenario expecting a reversal. Now, when we're in a market scenario where we're finding the market is causing the Donchian channels to move more flat, move more sideways, what ends up happening in this type of a marketscape is as we reach the upper band, a lot of times we see reversals. And as we reach the lower band, like you see here by this red circle, once again, we saw a reversal. And this is because, once again, the market was moving more sideways than trending heavily. As the market exhibits all the old school price action techniques that are showing strong bullish strength or strong bearish strength, we want to be on the lookout for using the upper and lower band as bounce points in the market until we have further confirmation that the particular bullish or bearish strength that is causing us to rally with such degree is coming to an end. We could consider using the Donchian channels as they provide an easy to interpret map of volatility based on how wide they're being drawn, as well as trading price history based on where the average line is. We won't gain actionable information by just staring at the Donchian channel by itself, as with most indicators. Instead, what we want to do is look at the channel. When we find an opportunity to enter based on the channel, we further confirm it with our price action knowledge or just outside information that is agreeing with whatever the Donchian channel is saying. All indicators are valuable and can help provide entries, but should never be relied on purely by themselves. One of the more popular trading strategies with this indicator is the breakout strategy. The thing that traders are looking for in order to quantify a breakout with the Donchian channels is they're waiting to see price repeatedly stick to the high location of the upper band or repeatedly stick to the low location of the bottom band. The reason that this is important or symbolic is because if we're hitting the upper band over and over again in a consecutive sequence, this shows a stabilizing in the upwards push that has recently created the highest point of price. This is said to be a bearish statement. As such, buying seems to make logical sense because the market is confirming that it is comfortable with this excessive buying pressure hanging around the recent all-time highs. If we were on the bottom side of this channel and we were pushing lows and we repeatedly were banging into these lows down here and we watched the market show an inability to work its way up off of that, then a sell might make a whole lot of sense in anticipation of a breakout, quote unquote, by the Donchian channel trading strategy. Trading reversals with the Donchian channel is a little bit different than many traders are used to with channel trading, because instead of just simply looking for that reversal off of the upper band or that reversal off of the bottom band, the more common way to trade reversals with the Donchian channel is to wait for really a crossover and then view that as a potential reversal in overall direction. So as we can see here, we had a crossover over the middle line. Price was previously trading above the middle line but below the upper line. This was indicative of a bullish move in the market. Now, as the market finally closes and trades below the middle line, now we can see that bearish momentum has come into the market, and this would have been an ideal time to look for a potential short position. The opposite holds true if we're trading below the middle line for a period of time with bearish activity, and then finally market activity causes price to close above the middle line. This crossover of the middle line can be viewed as a potential reversal in this bearish momentum that was being exhibited, and now we can expect some type of bullish momentum thereafter because we have crossed the middle line. The pullback trading strategy is very similar in nature to the breakout trading strategy, but it requires the market to never see the candles push beyond the upper or lower band. Otherwise, we would be in a breakout territory. So when we don't see the market being willing to break outside the upper or lower band, and we've witnessed some type of longer term bullish momentum, and the market has, say, come down and bounced off the bottom band a number of times without breaking through, this can be a good location to find value to look to go long into the market. The reason is because we're not gaining enough bearish pressure to actually break the bottom band, and instead we're looking to ride the overall momentum train. Now with this graph, we're obviously too zoomed in to say that we have a long-term bullish momentum picture with what we're looking at, but let's just imagine that we've watched the market rise for a very long period of time and then just zoomed in on this selection here, and this is what we've been met with. The opposite holds true if we're looking for a short, and the market has been trending downwards for some time. If we witness the market work its way to the upper band, but not being able to break above it, then we can look for an opportunity to short it and return to that overall bearish momentum. That is a relatively simple concept. Now, overall, my favorite trading strategy out of the three that we've discussed is going to be that crossover strategy. That's going to be the one that I like the most. We call that the reversal strategy because it's reversing the current short-term trend. When the market is pushing above the middle line, we can look for that long opportunity if it has been trending downwards before, and vice versa when we break the other way around. The advantages of using the Donchian channels come quite easily identifiable. We know that it can serve as a multi-purpose tool because it's helping us identify volatility as well as potential reversal points and identify current trend status. Then we also know that a good advantage of it is it's a great way to visualize that volatility, which comes into that multiple purpose category. We also know that it applies to any time frame. So once again, this makes it very applicable regardless of where you want to use it, and then it works with all assets. It's not just something that's going to work with just crude oil and not the ES, for example. It can be applied to anything. It is also very beginner friendly. It is simply 3 lines with a relatively simple view of what they mean as price interacts with them. And then it works very well in non-trending markets. In non-trending markets, those upper and lower lines can function very similar to how a Bollinger Band treats the upper and lower lines like support and resistance. The potential disadvantages that the channels have are something that really isn't too far off from pretty much the disadvantages any indicator might display. It's generally not going to be a standalone, one-size-fixes-everything indicator where you're going to execute trades without any other information behind why you're doing it. They can also provide false breakout signals. This really just comes down to reading the indicator wrong. If you read the indicator incorrectly, you're not accurate with your overall read of the market in conjunction with it, then you might find yourself with a false signal. Then it does rely on past data. It is not something that is forward thinking, so to speak. Instead, it's basing its lines on what has already happened. And then we also have that it doesn't identify cyclical moves. This is really just more of a matter of preference, but it's worth noting. And then it also requires constant market presence, which means we need the indicator to constantly have some type of data to be measuring, and the market needs to be doing something in order for it to be drawn. And then we have applies equal weight to all data points. The reason why this might matter to some is if you're more interested in the more recent market history, more so than the previous market history of, say, the day prior, this will not be the indicator for you because all data points are given equal weight. In summary, the Donchian channel is something that can provide serious value to a trader just due to the fact that it has such a Swiss Army knife of uses. It helps us identify volatility as well as trend direction and even market reversals. The key behind using it, as with just about any technical analysis-based indicator out there, is make sure that you use your existing price action knowledge to further confirm what the indicator is telling you. If you do this, the degree of success that you'll find with it will grow leaps and bounds. But until next time, folks, thank you all for joining me. As always, I will see you soon. Bzz.